U.S. employers added 390,000 jobs last month, according to the latest jobs report. And even though the numbers are better than expected, fears of an economic recession remain. The Federal Reserve is attempting to bring down inflation, but is the effort to provide Americans with real relief enough? Sultan Magji is the former Chief Innovation Officer for the Federal Deposit Insurance Corporation and currently a professor at Duke University. He joins me now. Thanks for being with us. So the Fed is raising the interest rate to avoid a recession. Will that work, or are we headed for a recession? I think that's what everyone wants to know.
Well, I think I want to know that too. The fact is the Fed is playing kind of a dangerous game right now. They've got to slow the economy down and kind of cool things off a little bit to get inflation under control. But in doing so, there's a real opportunity that they're going to overcorrect and slow the economy down too much. You know, the vast majority of businesses in the United States have benefited from the Federal Reserve playing a more active role for the last few years, and in some ways printing money and using that to buy things. So constantly feeding more money into the economy. And now the Fed has tapped the brakes pretty hard, and they're going to be doing it for a while. You know, the rates they're going to continue to have these, 50 basis point, increases for a while. And there's a lot of concern that once rates get over, let's say 3.5%, that it could tip us into a recession pretty quickly.
And you say we're surfing three waves. Explain that.
Mm-hmm. Yeah, so there are three waves going on. The first is we have to get this inflation under control. And that's something that's hitting every American on a daily basis, whether it's, gas in your car or groceries or buying things that you have to, to just like have a home. This is all getting more and more expensive at a pretty quick rate, somewhere between 6.5% and 8.5% is what we're seeing for the last few months. The second is, in those interest rates that we're now having to pay more for things like home loans and auto loans. And, a lot of people are looking to the auto industry and places like Tesla and GM and Ford to see if we're starting to see more cars, sitting on lots. And then the third is what we call quantitative tightening. So the Fed has been buying a bunch of stuff for the last few years. And, beginning just a few weeks ago, they started to sell them. And it's hundreds of billions of dollars of assets they're trying to sell. And balancing all three of those things at the same time has never really been done before. Certainly not in our lifetime. In the 90s, we saw a kind of a version of this. In the 70s, we saw, again, kind of saw a version of this, but it's not something we've seen recently.
And inflation persists, right? But layoffs are at record lows. The economy is adding jobs consistently. Households and businesses are still spending. So I think it's confusing, right? Because if the Fed is raising the interest rate, but all of these other factors look to be positive, why are we headed to a recession?
Well, we're not 100% going to be in a recession, so I don't want to be the first guy to say that. But we are certainly watching things slow down, right? We're seeing energy prices very high. We're seeing all of these things get more expensive. And as we slow down the feed of new money into the system, that's going to cause a disconnect. And we're starting to see these friction points. Having, 2 jobs for every one person who's looking is fantastic. And basically, as long as we've been tracking those metrics, this is the first time we've seen that. The problem, though, is that the jobs aren't paying more. They're not paying enough to catch up with where the inflation has gone. We haven't seen salaries go up by 6 or 7% every month, for quite a while. The average salaries haven't gone up, and so you see a gap developing between what people are making and what people are having to spend. And what people are making is incrementally going up, but what they're having to spend is going up a lot more. And we're seeing a big disconnect there.
Yeah. How long do you think we're going to be dealing with inflation? Are we going to be feeling it any differently than we are right now?
Yeah, that's a fantastic question. Some of the best minds out there are saying we're going to see this for another 12 to 18 months. And I frankly haven't seen any data that says that that's not going to be true. And then, we'll have a correction as that we go into that. So let's just say we see inflation for another 12 to 18 months at the rate we're going. Well, the Fed's plan to get inflation under control is already that long. So they'll probably have to extend past that a little bit. I think we're looking at probably 2 years of some variability and potentially even longer if the Fed doesn't act a little faster.
And finally, before I let you go, what is Congress's role in this? What are lawmakers doing to help the problem?
Not as much as I think a lot of us would like, but it's important to remember that monetary policy sits inside of the Federal Reserve, and it is independent to a degree, both from the executive branch led by the president and the legislative branch that runs through Congress. Congress could be doing a lot more in terms of passing laws that do things to make it easier on the average American. Doing things like ensuring that we have the ability domestically to produce enough baby formula. That's a great one. That's something Congress could do. But in terms of actually implementing monetary policy, that's entirely on Jay Powell and the rest of the team at the Federal Reserve.
Salta Maggi, thank you.
Thank you for watching. Go to newsnationnow.com to find News Nation on your television provider. And don't forget to click the red subscribe button below to get more of News Nation's fact-driven, unbiased coverage.